Welcome to NordSIP. The integration of ESG factors into investment management processes, which originally started mainly within listed equities, has gradually made its way right across most mainstream and alternative asset classes in institutional portfolios. This has been driven by policymakers and regulators, as well as the realization by investors that sustainability themes have a significant impact on risk and return. We checked in with Jens Ernberg, co-head of private credit asset management at Capital Dynamics in New York, to find out what role ESG principles play within his firm's US middle market strategy.
The US has been slower in general to adopt ESG principles in their investment processes and investment monitoring processes as well. That is particularly true in private credit, and there are a number of reasons for that, and I'll go through that. We here at Capital Dynamics, as I mentioned, have tried to be on the forefront of embracing ESG practices in all of our investment strategies. Part of that's driven, as I mentioned, by our global footprint and the fact that we've been influenced by you, our investors, in moving in that direction. We've also been early signatories to the UN PRI, as I mentioned, which is, I think, an evidence of our intent to be leaders in implementing ESG practices across our portfolios. So interestingly, the US lower middle market obviously is a significant driver of not just the US economy. They account for about a third of the GDP and a third of employment here in the US. They also globally represent about the third largest economy in the world. And so they're a meaningful force. Lower middle market US is a meaningful force in the world economies, and certainly a meaningful contributor to environmental impact. They're also a meaningful contributor to social good, whether it's employment practices, tax revenues generated from lower middle market companies in the US are fed into essential services. So they really represent a strong and powerful force globally. And so implementing ESG practices, we think, across this important market segment will have broader global implications, and certainly strong implications in the US, where they are such an important factor across the economy. So historically, lenders, generally speaking, have been employing ESG practices in their underwriting really forever. It's been, though, a practice used to really negatively screen for investments. So companies that underperform across the three ESG dimensions, and I'll highlight that in a second, tend to be reasons to eliminate those investments from consideration. However, we think there's a really strong argument to flip that or supplement that investment practice using ESG attributes of a company as a means to really identify companies that are likely to outperform over time and across cycles. We think businesses that focus on sustainability across the three ESG dimensions are really more resilient businesses. They tend to have greater revenue generation, certainly higher margins, and greater flexibility when it comes to access to capital. All of these things point to resiliencies. Of course, in the equity markets, I think there are benefits from a valuation perspective. We're less focused on that, although there's really an implication for us in terms of our loan to values when it comes to valuation. But from our perspective, and again, I mentioned it earlier, outperformance in credit is really avoiding defaults and maximizing recoveries upon default. So investing in resilient companies with advantaged cost structures and greater flexibility, we think builds those more resilient portfolios that are likely to outperform over time and across cycles. There have been some challenges to implementing ESG, and I'll talk to those in a minute. In the credit space, part of that is really driven by the fact that lenders don't have control over the businesses they lend to. That said, we do have a lot of influence. Certainly, companies are looking for financing from us, and in the context of that, depending on the market dynamics you live in, you have the greater or less capacity to influence the structure of those documents and contracts that we issue for our loans. We in the lower middle market think we have an advantage position, again, for the reasons I mentioned before. There's a supply-demand imbalance that allows us to be a scarcer resource in the markets we operate, which gives us disproportionate influence, we think. So again, as I mentioned, historically, lenders have really focused on negative ESG screening. So companies with poor environmental performance, where you see disproportionate litigation claims, you see elevated waste in their operations relative to their peers. You might see remediation costs, or certainly there's the anticipation that there might be remediation costs. All of these are negative credit factors that would sort of eliminate investments from consideration. Same risks around social, poor workplace accident record, that increases the cost of workers' compensation, insurance. It probably increases turnover. Turnover is one of the highest impact cost factors in companies. Retraining and hiring employees is incredibly costly for businesses and impacts margins. Uncompetitive compensation in particular, we've seen that through this pandemic cycle, that if you're not competitive from a benefits and compensation perspective, you will lose people. And again, that'll impact turnover and costs. Governance, lack of board oversight, weak reporting, lack of transparency. All of these things are significant negative credit profiles that would lead to an investment being eliminated from consideration. So all of these factors are still in place. Of course, companies will be eliminated, but we think now supplementing that screening with a positive ESG screening, looking for companies that are focused on sustainability across these three dimensions, is likely to generate a more resilient portfolio that will outperform over time and across cycles. So looking at companies' waste management policies, do they have a closed loop water treatment, for example? Do they disproportionately focused on energy savings, energy consumption, and make sure they're as efficient as possible? Again, these are relative analyses, so looking at their performance relative to other companies. All of these translate into not only cost advantages, but certainly if you're favorably inclined toward the environment, if you're focused on net zero, for example, and bringing down your carbon footprint over time, those are also reputational benefits for a company that will, we think, help attract better talent and certainly retain better talent over time. The social attributes that we look for are lower turnover, disproportionate compensation, or not disproportionate, but relatively better compensation when you look at this business relative to others and their peers. We look for companies that offer safe and inclusive work environments. Again, that speaks to turnover and attracting and retaining the best talent. So all these factors, same thing with board composition, how companies are reporting, how they're treating conflicts of interest. All of these things, if there's a focus on sustainability along these dimensions, we think translate into businesses that will be more resilient and allow them to outperform through cycles, importantly. So what does a strong ESG company really deliver for us as investors? For one, they tend to have a more sustainable business model. Their products and services tend to be more enduring through time. There's not risks that they face with respect to the products being unsafe or delivering, an unhealthy food product, for example, or risks of litigation around the product. This translates generally into favorable reputation and strong brands, and certainly less attention from regulators. All of these things are factors that we think speak to a very resilient business model and performance over time. Certainly on the resiliency side, the implementation of these ESG strategies allow you to reduce your cost structure in particular. So less waste, obviously, allows for stronger margin. Lower turnover with employees allowed for again, lower overall cost of work unit input, if you will, and therefore better margins, better cash flows, and better access to capital. That, for the moment, I think is even more pronounced in these markets where investors are looking for ESG companies with strong ESG attributes to lend to. So if you think about access to capital, it's not just about the performance, but in today's market, there's a real focus on funding companies that have this profile. So ordinarily they would have more access. I think in this environment, they have particularly strong access to capital, which is again, a very significant advantage for these businesses and speaks to their resiliency. And then outperformance, all these factors speak to outperformance, higher revenues with better products and services. That speaks to the ability to pass through higher input costs to customers. It also translates into higher margins and greater capital efficiency. So all around, there's real benefits, we think, to really investing in companies that deliver sustainability or focus on sustainability across the ESG dimensions. Here at Capital Dynamics, we've developed a tool for measuring ESG of a company. We rate companies at underwriting for sustainability across the 3 ESG dimensions, and then we repeat that rating on a quarterly basis to register whether there's improvement or a decline in ESG performance. A decline obviously will lead to repercussions from our perspective. That could be as simple as meeting with management teams and putting together a remediation plan to get them back on track to an improving ESG profile, to either selling the asset in the worst case, or in the case of private equity managers that own the businesses, perhaps limiting our commitment to those over time. In terms of key topics in our underwriting, the environmental footprint, as I mentioned, and waste is a significant, water treatment, et cetera, is a significant factor in our underwriting. Health and safety record, turnover, human resource policies. We look at the handbooks to understand the human resource policies, certainly around diversity and inclusion, but also about compensation and benefits, as we mentioned. Workers' comp is an area that we really focus on to understand the risk environment that we're operating in terms of their operations, whether there's a lot of accidents and poor work environments. We also look, by the way, down at, from a social perspective, we really look at vendors, relationship with vendors and supply chains. In this environment, certainly supply chains have become global and protracted, and understanding the health and safety and environmental record of the underlying vendors is equally important. So we financed a number of companies that source product from Asia. We spend a lot of time rating those operations and causing our private equity partners to audit those companies for labor practices and environmental practices. We think that's incredibly important in terms of integrity of our process, not only focusing on the portfolio company, but the orbit of that portfolio company as well. We also tend to look at the sponsor, and here we take a very active role, and I'll speak to that in a second. Lower middle market sponsors in the US are quite unfamiliar with ESG, and so we help sponsors along in developing practices around ESG investing, and certainly try to highlight the benefits of focusing on sustainability and ESG for their portfolio companies. So the challenges that we face as creditors in implementing ESG practices are somewhat significant, but we think there's a solution to that. And we think the real important factor that we have as a lender is really to exert our influence over the portfolio company management teams, as well as the sponsor in the underwriting process. And again, we think the dynamics in the lower middle market allow us to have much greater influence in the process of implementing ESG practices at companies and at the sponsors. So the first step for us is really educating our sponsor and portfolio company community on ESG, the benefits of looking at ESG attributes and the improving performance of businesses that focus on sustainability across ESG and what that means for valuation and returns at the end of the day. And we're getting great reception from lower middle market managers here in the US looking for our guidance in this regard. And so I think that's an important factor in the implementation process and making sure that the middle market is starting to adopt these practices more broadly. And then again, using our influence, and this is particularly true in the lower middle market, where we really can influence structure and pricing, and particularly here in regards to the structuring, we're increasingly implementing factors in our documents that will motivate underlying portfolio companies to move in the direction of improving their ESG attributes. And that starts with measuring and monitoring ESG attributes. And I think we'll end with us adding specific performance covenants around those attributes. It's early days and we're gathering data, so it's not an easy process to implement. We've certainly seen some implementation of covenants and rate ratcheting in Europe, and it's coming to the US to a degree. We just think you have to be careful in that implementation to make sure A, that you have the relevant data to do it and measure it appropriately, and B, that you're motivating the right kind of behavior at the portfolio company level. The final is that small companies and sponsors don't really have the resources, both human and technological, frankly, to implement a lot of these practices. These are entrepreneur-owned businesses that are bringing in sponsors of their first institutional capital. A lot of the institutionalization is around data gathering and analysis and synthesis. And we, as part of our underwriting and work with the sponsor, try to help them identify the right KPIs to measure and to monitor through the life of the investment to help improve the ESG attributes over time. And that's an ongoing process. We do that through questionnaires initially, and then through data gathering. And then ultimately that'll translate, we think, over time into actual performance covenants. Today, there's really some expectations in our documents. There's no true covenants, but we will be moving toward more covenanted documents in the very near future. So what do we do to motivate? Again, we think there's real benefits as part of the institutionalization of these benefits, the institutionalization of these companies to driving environmental social objectives across the businesses. The performance merits are clear. We've seen it in historical performance of companies that are focused in this direction in terms of what it means from a brand perspective, from a human resource perspective, et cetera. We do think that in order to motivate behavior and influence these companies, there is a place for ESG covenants. We think these are powerful tools. We use it obviously on the financial performance side to make sure that the companies are performing to expectations, and if they miss those expectations, those covenants allow us to come in and speak to the management teams. We expect to move that forward on the ESG side as well to kind of motivate behavior there. So I think initially those covenants will be around environmental performance, where there is an element of measurability there that is objective and that can be measured and monitored. We will also start implementing rate ratcheting where appropriate. Again, there has to be a level of measurability and performance management available for those rate ratchets to be effective and potent, if you will. ESG covenants here in the U.S. have been limited in terms of financings, but we do expect to lead the way here in implementing these covenants and ratchets over time in our portfolios. So just in summary, I think it's clear, or it's important to note, I think, that ESG has been really an integral part of underwriting in credit for forever, really. But the historical focus has really been on risk management. We believe that implementing ESG screening, positive screening of ESG and sustainability of ESG attributes at businesses allows us to identify businesses that are likely to outperform over time and across cycles. And so the dual screening of a negative screen that really eliminates investments from consideration to adding a profiling of the business with respect to their sustainability across the ESG dimensions will allow us to build the most powerful or most resilient, portfolios over time, those that will outperform, relatively speaking, through cycles. And again, we're very focused on the downside protection here. So we're looking at companies that we think will outperform in downside scenarios, allow us to preserve capital for our investors, not as much on outperformance from an equity valuation perspective, although that in turn drives better performance of the portfolio as well, and certainly can drive recoveries. I think more flexibility in recovering if you have a business that is relatively outperforming others. Finally, driving and motivating portfolio companies and private equity managers to implement ESG in their portfolio companies is important. Lower middle market, again, and the broader middle market is an important factor in the US economy and global economy. And so any influence that we can have over this population of companies will have a significant global implication, we think. So it's important not just to speak about the importance of ESG, We want to try and motivate underlying portfolio companies and managers to implement ESG practices in their underwriting and operating practices. To do so, we think part of it is de-education, the support that we provide. And then part of it is actually putting in motivating tools, whether they're negative motivating through implementing covenants or positively motivating in terms of rate ratcheting. We are in the process of adding features like this to our loans. Again, we think we need to be careful in that process, in that the data has to be available and has to be measurable and has to be objective. And it has to be predictive, frankly, of performance, to make sure that not only are we doing the right thing from an ESG perspective, but we're also acting as fiduciary and delivering better returns for our investors. So it's an incredibly important area. We think there are real benefits to implementing ESG practices, and we're evangelizing that with our private equity managers and our underlying portfolios companies, and we think that over time will have a very positive influence on the U.S. economy and the global economy as well. And that concludes my remarks. I think we're opening up again for questions.
Thank you, Jens. The first question we have is, how do you measure and monitor some of the KPIs that you would use in your ESG covenants or contractual agreements?
Yeah, that's a very good question. And as I pointed out, it's very important for us to be able to identify the right data to gather that is predictive in driving improvements in ESG over time. And that's subjective as well, in the sense that there's no ability to really manipulate the data. You know, some of the data is easier to gather than others. And as I mentioned, lower middle markets tend to be somewhat under-resourced when it comes to data gathering, monitoring, and synthesis. And that's where I think we and our private equity partners can be very helpful in adding that layer of institutionalization to business when it comes to the data gathering and monitoring and synthesis. But there are certain areas, as I mentioned, they're sort of easier and more readily measurable today, such as employee census. I mean, I think it's very easy to look at what your demographics look like. Environmental footprint can be challenging. You know, we're today exploring third-party vendors that are able to do via proxy an environmental footprint analysis of any given business and how they perform relative to others. So using that as an objective, if you will, measurement of a portfolio company environmental footprint, and saying, look, here's where you stand today in terms of your footprint, and here's where you stand relative to your competition, and then using that same vendor in terms of monitoring the business over time and re-rating the business over time would allow us to effectively implement some form of covenant around that specific data. But certainly it's a challenging topic, and standardizing the data and making sure it's measurable and objective and predictive is not an easy task. It's something that we're very focused on trying to figure out how to do. But again, I think the early and easy opportunities are around data that's sort of readily available around employee census, turnover, board representation, demographics of leadership, et cetera. All those things I think are kind of easy to measure, objective, can be implemented and can be used as motivating tool, or where covenants can be used as motivating tools to drive an outcome that we think will be positive for the company over time.
A second question would be, do companies perceive sustainability-related issues to offer opportunities to their business? And how much have they been able to realize these opportunities?
That's also a good question. I think it's really a work in process. I think certainly a lot of the psyche of U.S. lower middle market corporates, or I should say the preconceived notions among a lot of the smaller businesses in the U.S. is that ESG practices have no real benefit and just add cost to the business, and that they can live with a certain level of waste as long as they can be price competitive. And so it's a little bit, as I mentioned, it's a little bit of us and other constituents, private equity managers and private credit managers, when it comes to private investing, educating these companies on the benefits that they can realize through implementing ESG practices. It is, though, fighting against some conventional wisdom. And, and I think, again, because of the lack of data in the lower middle market, measuring the benefits today has been quite challenging, and demonstrating objectively to the underlying portfolio company that improving along these dimensions will translate into better performance is not that easy. But I think what we're finding is we're getting strong receptivity from sponsors. These are institutional investors. They understand what, lowering waste, lowering turnover, and improving your image and lower regulatory scrutiny. They understand what that means in terms of benefits to the business, and what that means in terms of economic performance and therefore valuation. So we have ready and willing partners in implementing this, but we are fighting a little bit of an uphill battle. And it's not that easy, to your question, to demonstrate without the data that the benefits are there. But having us influence along with a sponsor that's in a controlling position really implement these practices at an operational and board level, we think will continue to drive lower middle market companies to embrace these practices and recognize the benefits of it.